All right, let's dive into Frequency Electronics, ticker FEIM. They just dropped their Q1 earnings and, well, the market's reaction was, let's just say, pretty decisive.
And this is the number that says it all. After hours, the stock got slammed, taking nearly a 10% haircut. That is a brutal response, and it immediately sets up this battle between what the company is saying and how the market is actually voting with its money. So that really is the question we need to answer, right? Was this just a temporary slip-up, a simple timing issue like management claims, or is this a sign of a much deeper problem? Let's dig into the numbers that sparked all this drama in the first place. Okay, first things first, let's look at the hard numbers that spooked everybody. The top and bottom line results were, to put it mildly, not what Wall Street was hoping to see. So you look at the top line, the revenue, and it's an obvious miss, off by nearly $3 million. But honestly, the real carnage was in the profitability. GAAP earnings per share absolutely cratered by 72%. And look at the gross margins. They collapsed from over 44% down to under 37%. These aren't small misses. These are the kind of numbers that make investors hit the sell button first and ask questions later. But just as the market was panicking, management got on the earnings call with a very different story. Their entire argument hinges on one single idea. This was just a hiccup. It was all about timing, not a fundamental problem with the business trend. And this, right here, this is the money quote from the CEO, Tom McClelland. He was absolutely emphatic on the call. No business was lost. In fact, he went a step further, signaling that one of the programs that got delayed is actually about to get bigger. This is the entire foundation of the bull case. The revenue didn't vanish, it just slid into the next quarter. So management's case really comes down to a few key points. First, they say the delays were the customer's fault, not theirs. To prove that demand is still incredibly strong, they pointed to a record-high funded backlog of $71 million. Then they put their money where their mouth is, announcing a brand new $20 million share buyback, and basically declared, hey, those problems, they're already in the rearview mirror. Now, beyond all this short-term noise, management spent a ton of time on the call talking about their big strategic pivot. They're aiming at a massive long-term opportunity, and that opportunity is all about quantum technology. And what's really interesting here is how real they're making this strategy. This isn't just some fuzzy PowerPoint idea. They've actually opened a new lab in Boulder, which is a major hub for this kind of research. They've gone out and hired top-tier scientists from NIST, the National Institute of Standards Technology. And maybe most importantly, they've put a deadline on it, saying they expect this new lab to actually start adding to the bottom line by the third quarter. So for everyone watching this company, here are the key dates to circle on your calendar. Next month, you've got their Quantum Summit. By the third quarter, that Boulder lab is supposed to be making money. And by the middle of next year, we should actually see prototypes of their key magnetometer tech. These are the milestones that long-term investors are going to be watching like a hawk. Okay, so let's take a breath. We've got two completely different stories here, right? You have management saying, don't worry, it was a temporary slip, the future is bright. And then you have the market screaming the exact opposite with that massive sell-off. We need to put these two narratives side by side to really understand what's going on. In this chart, it just lays out that tug of war perfectly. The bulls are clinging to the story. The delays are temporary, the backlog is huge, the buyback shows confidence, and hey, look at this amazing quantum future. But the bears, they're pointing at the cold, hard facts. The miss was huge, margins got crushed, the company gave no formal guidance, and there's a real risk they won't be able to turn that big backlog into actual profits. So why did the market react so viciously? This slide is the key. You have to understand, FEIM wasn't some beaten-down stock just limping into its earnings report. It was an absolute rocket ship. We're talking up over 70% in just 3 months, and well over 100% for the year. The stock was priced for absolute perfection, and when you have a run like that, there is zero room for error. The slightest stumble was going to trigger a wave of profit-taking, because right now, investors want to see results, not just hear a good story. So, let's pull all of this together. Where does the stock go from here? What's going to happen next? It's time for our prediction for the next earnings call. This is it. This is the question for anyone looking at this stock right now. Do you buy the dip and side with management's optimistic story, or do you stay on the sidelines, trusting the market's initial brutal reaction? Okay, here's our official call for Q2. We fully expect revenue to rebound. Management's story about delayed programs seems plausible, and that money has to show up eventually. However, and this is a big however, we predict the stock price itself is going to be stuck in the mud. The market feels burned. It's officially in show-me mode, and it's going to wait for solid proof that management can actually execute before it's willing to push that stock price higher again. So that brings us to our final take. We're giving this a market perform rating. While that long-term quantum story is genuinely compelling, the near-term execution risk is just too high to ignore right now. We believe the stock is going to trade in line with the broader market until the company can deliver a clean quarter and prove to everyone that Q1 was truly just a one-time thing. And remember, this is not financial advice.